Joining us, Nicholas Mersch, the portfolio manager, stock picker at Purpose Investments. Nicholas, thanks for being here on the Schwab Network this afternoon.
Thanks for having me.
Hey, do self-driving cars fit your definition of purpose? Take me through your guys' mandate and how you invest.
Yeah, absolutely. So I run the Purpose Global Innovators Fund here that focuses on growth equities with the focus in technology. Now, in terms of the self-driving cars, we don't have a position currently in Tesla, although it has been a massive beneficiary of the self-driving movement. I think a lot of the kind of current capabilities of the models, if you look at the existing kind of hardware that's installed in these, it still has a lot of work to go. And I think that anytime you kind of have one of these pieces of technology, and I think it was Steve Jobs that said it's true technology when it's indistinguishable from magic. So the first time I felt this was when I was playing around with an iPhone as a kid, and then you feel it again when you go into sort of this full self-drive when you're in a Tesla. And now, like whenever I go and I put the full self-drive on, what I'm seeing is that it's stopping at green lights sometimes, and it doesn't work around some of the edge cases. So I still do think there's a lot more work to go on this full self-drive technology. But all these Waymo, the volume of rides that is going up and up over the recent period that we've seen is really encouraging to the space overall. And I think this is going to be a massive market going forward.
Okay. It seems like you have some favorite tech companies, just judging by the income-driven strategies you've built out through ETFs. Amazon, Apple, Alphabet, Berkshire, AMD, NVIDIA, Microsoft, Tesla, Meta, all part of the yield shares suite. Tell me how those function. What's the purpose of those?
Yeah, absolutely. So we created these yield shared products to really get income and earn monthly yield while housing your favorite securities. And the process behind this is we write about a 50% covered call and directly own the underlying security. And then we also add a component of 25% leverage on top of that. So what ends up happening is we have a yield of around 20% in terms of the Tesla share. 20% again in NVIDIA. And this product has gained really a lot of traction because what we wanted to do is really simplify a lot of these structures, because we saw some of these 2 and 3 times levered products going out into the market. And I think these were really highly speculative. And we also saw some other covered call strategies go to the market where they were 100% underwritten covered calls. And while some of these printed this sort of fancy yield on a brochure, they didn't really participate in the total return profile of some of these underlying securities as well. So we end up capturing a lot more upside on a total return perspective while generating that monthly yield. So these products have been a massive success with a lot of investors, and we're able to add yield to some of the favorite household names.
So are they viewing it as an addition, or are they viewing it as a replacement, as a preferred way to get exposure to these companies?
Yeah, so we originally positioned this as working in tandem with any single stock positions that the investor did have. But what we found is that with the success of the product and emphasizing, again, that total return profile, a lot of investors are starting out with maybe half of their position in these products, seeing how it trades, seeing that monthly yield come, and then shifting the entire allocation of that position to this product.
Got it. Okay. There is, it seems, kind of an implicit message, too, about maybe some of the sustainability of like extreme upside, or is that sort of, am I projecting there at all?
Yeah, and I think if you look at some of these charts, a lot of them are just these kind of slow up grinds to the right. And I think I've been a pessimist and an optimist in the past, and it pays a lot more to be an optimist.
For sure.
And if you look at a lot of these companies, they're in these massive secular growth areas, and you want that long-term exposure, better upside capture in terms of that long-term exposure when buying and holding these securities that do grow in these secular themes. So we do want to align a product with that long-term trend and long-term holding in order to participate on the upside.
Okay. Your Innovators Fund, if we branch out and connect some of the macro across asset stuff for a moment, ticker PINV, 75 BIP cost, tech, the vast majority of it, but you've also kind of peppered it with real estate. There's a 4% crypto in there. This is a pretty interesting approach. Do you view this as sort of like an all-weather portfolio, or is this still risk asset kind of equity based?
Yeah, a lot of these are still risk asset asset and equity base, and the real estate holdings in there are two of the data center companies.
Got it.
So Digital Realty and Equinix, and a lot of that was just in terms of the play of building out these capacities. We also own some nuclear names as well in terms of the power exposure. And we did, on the day of the election, actually add a much larger crypto position as well. We also previously played a company called Core Scientific that was in the crypto mining space, and they're converting those facilities to AI high performance compute facilities. So there was an option there in terms of it had a lot of exposure to the crypto movements, and then also some optionality in terms of blue sky upside from converting their existing facilities to these AI facilities. So the approach here in this fund is really just sort of taking a much more verticalized approach in terms of investing in these long-term secular growers. And AI is the hot topic of the day, and we want to make sure we're covered on all bases across the entire value stack. We have held a significant portion of software and semiconductors, and there's a lot to be said about the kind of rotation that we're seeing in the market. And I think a lot of people had left software for dead. They said AI is coming in, it's going to make everybody much more productive. So we're going to see a lot of these kind of seat counts really start to fall. And software is traditionally sold on this SaaS sort of seat per head per year kind of basis. And what's happening now is this. It was counted out fully for dead. But if you look at the first 5 months of the year, the SOX, the semiconductor index, was up 23% versus the IGV down 3.7%. And if you look at these indexes over the last 6 months, this is completely reversed. So SOX is down 4% and IGV is up a whopping 34%. So software is really just back from the dead here. And because what they've done is they've layered on a lot of these AI agents within their existing application infrastructure that have really taken off at these companies. And they're doubling revenue quarter over quarter in the AI specific products. And I think we're going to start to see this shift finally from the infrastructure component of AI to the application layer. And I think it's going to be incredibly exciting there.
I think some really good points there that rang very loudly this past week with Salesforce and their agent tools. Obviously the crypto stuff too. This is, you're on Toronto Exchange, is that right?
That's right, yeah.
Okay, you got anything coming to the US?
Yeah, we do have a couple products in the US as well. But right now, a lot of our holdings just are Canadian based.
Understood. Okay, it's a super interesting approach to the fund. Thanks for taking us through it. Really interesting perspective, Nick. Good stuff.